Okay, let us see the questions on depreciation accounting now. So the first one is on sinking fund method. So a company purchased 4 years lease on 1st April 2010 for rupees 10 lakh. It was decided to set up sinking fund account. Investments will fetch interest at 12% per annum. Sinking fund table shows that in order to have rupee 1 at the end of 4 years, we need to invest rupee 0.209234 every year at 12% per annum. Investments were made in 12% government bonds of rupees 100 each at the face value. Interest was due on 31st March each year. 31st March 2014, the investments were sold for 698,940. On 1st April 2014, the same lease was renewed for a further period of 4 years by payment of rupees 12 lakhs. Show the lease account, sinking fund account and sinking fund investment account for 4 years. So that is 10-11, 11-12, 12-13 and 13-14. So for the year ending 31st March 2014, till that we have to show the amounts. So this is a sinking fund method of depreciation. Now when the lease is purchased on 1st April 2010 for 10 lakhs, so obviously the entry will be lease account debit to bank rupees 10 lakh. Then at the end of the year you will keep aside the amount for depreciation, and they are saying for 1 rupee we need to invest 0.209234 every year. So for 10 lakhs, how much? So it will be 10 lakhs into 0.209234. So 209234 is going to be your depreciation amount each year. So the entry will be depreciation account debit to sinking fund account. So 31st March year end by depreciation account to sinking fund account. And then what you will do is you will invest this money in 12% government bonds on the same day. So 12% government bonds account debit to bank account. Now the only thing is they are saying it is to be invested in the multiples of 100 rupees, right? Because the face value is 100 rupees. So then you have to round off the amount to the nearest 100 rupees. So 209234 will become 209200. So government bonds account debit to bank account. So the first year will be over. They have not asked us to prepare the depreciation account, otherwise depreciation would have been debited. And then finally the balance in depreciation would have been transferred to P&L. So in the first year, the balance in bond account will be carried down, which will become the opening balance for the next year. Same thing for sinking fund. Credit balance will be carried forward, which will become the opening balance for the next year. And then same for lease, which is your asset account. Balance will be carried down, and that will be the opening balance for the next year. Now second year again, first you will charge depreciation. So amount of depreciation will remain same, 209234. Now in the second year you will also get interest on the amount which you had invested earlier. Now last year you invested 209,200, so that's the opening balance for the second year. So on 209,200 at 12%, so you get interest of 25,104. So for that your entry will be bank account debit to sinking fund account. This will be credited to sinking fund. So 25,104. So that's the interest. And now in the second year the amount that you will invest is not just the depreciation amount, but also the interest will be reinvested. So the total amount to be reinvested in the second year is 234,338. Rounded off to nearest 100, it will be 234,300. So 234,300. Bonds account debit to bank account. So the balance in the second year, again it will be carried down, which will become the opening balance in the third year, on which you will have interest in the third year. Then balance in sinking fund also will be carried down, that will become opening balance for the third year. And lease account no change, so the balance will be carried down, and that will become the opening balance in the third year. Again third year, same sets of entries will be followed. So first you will charge depreciation, 209,234. Now in the third year, you will get interest again on the opening balance of the third year, which is 443,500. So on 443,500, 12% rate of interest, 53,220. So again, bank account debit to sinking fund account. Actually, it is a combination of two entries. First, you will say bank account debit to interest on sinking fund investment, and this interest on sinking fund investment you will transfer to sinking fund account. So that is why here you are seeing the description by interest on sinking fund investment. So in the third year, the amount that you will invest is 209,234, which is depreciation amount plus the interest portion. So 262,454. Rounding off to nearest 100 will be 262,500. So 262,500. Bond account debit to bank account. Again, the balance will be carried forward to the fourth year, and sinking fund balance also will be carried forward, and machinery lease balance will be carried forward to the fourth year. Now, in fourth year is the last year. So, in the last year, again you will charge depreciation obviously because you have used the asset for the full year. So, 209234 again by depreciation. You will also get interest in the fourth year on the opening balance of the fourth year. So, that is 7,06,000. So, on 7,06,000 into 12%. 84,720. So, that is interest. Now, the only difference is in the fourth year, you will not reinvest the money because fourth year being the last year, you need to actually sell off the investment and get money to utilize it for purchasing the new asset. So, reinvestment entry will not be there. What will happen is, whatever is the investment, it will be sold off. And the question says, it was sold for 698,940. So, it will be bank account debit to sinking fund investment account, which is your 12% government bonds account. So, bank account debit to 12% government bonds account, 698,940. So, you have book value of 7,06,000 and you have sold it for 698,940. So, that means it is a loss. You have sold it at a lesser value. So, this loss again will be transferred to sinking fund account. So, by sinking fund account 7060. That is how you will close the 12% government bonds account. So, 7060 will be debited in sinking fund. Now, the life of the old asset has come to an end. So, the asset account also will have to be closed. You will close this asset account, lease account, by transferring the balance to sinking fund account. So, by sinking fund account. So, that is how the fourth year also will get closed in lease account. And sinking fund account will be debited by 10 lakh. And then whatever is the balance in sinking fund, that will be transferred to P&L. So, 7080 transferred to P&L. This is how your sinking fund account also will get closed. Same as your loss on sinking fund investment. Here we have a small difference because of rounding off. Because the exact amount that we set aside as depreciation, the same amount was not reinvested. We reinvested in the multiples of 100. So, that is why there is small difference. Otherwise, whatever is the loss on sale of investment, that same ideally would have been the balance in your P&L, balance in sinking fund. This is how you prepare the accounts under sinking fund method. And then, since they have not asked us to prepare the account for the fifth year, we have not shown that. But otherwise, now what will happen is in the fifth year, on 1st April 2014, the same lease was renewed for a further period of 4 years. So, you will have again in lease account debit to bank account rupees. This time the amount will be 2. Now, this is a combination of purchase as well as sale of asset before the end of the year, and it also includes change in the method of depreciation. So, all in all, you will learn all those things in one question. So, X Limited purchased machine on 1st April 95 for 1.60 lakhs. 1st October 96, another machine was purchased. 1st October 97, first machine was sold, and on the same day, one more machine was purchased. Then on 1st October 98, the second machine was sold. Rate of depreciation 10% on original cost. On 31st March 99, the method was changed to WDV. The new rate being 15% per annum. So, prepare machinery account for 4 years. So, 1st April 95, 1.60 lakhs. Here, the working note becomes crucial. So, for each machine, you will have separate columns to show the calculation separately. So, first machine, 1.60 lakhs on 1st April 95. Nothing else is happening in the first year. So, you will close the year by charging depreciation. So, depreciation is straight line method initially, 10% per annum. So, 10% of 1,60,000 because this is purchased on 1st April. So, you will have depreciation for the full year. So, 16,000 is your depreciation. Remaining balance will be carried forward to the next year. In your working note, you will say 16,000 less depreciation. So, your book value becomes 1,44,000. So, this depreciation is for 95, 96. This will get debited in depreciation account, which will then be transferred to P&L. In the second year, which is 96, 97, before the second year ends, you have purchased second machine for 1.04 lakhs. So, 1.04 lakhs second machine. So, entry will be machinery account debit to bank account 1st October 96. Now in the second year, your depreciation will be, on the first year, obviously again it will be for the full year, 16,000. Then the second machine you have purchased on 1st October. So for the year ending 31st March, the depreciation will be only for 6 months. So 1,04,000 into 10 upon 100 into 6 upon 12. So that will be 5,200. So your total depreciation for the second year will be 21,200. So again, depreciation account debit to machinery account, 21,200. Third year, that is 97-98. The first machine was sold off for 1.20 lakhs. So let us first see the entries for this. So it is sold on 1st October 97. That means first we will calculate the depreciation. This was the opening book value for the third year. So for the first machine, on 1st October 96, when it was sold, the depreciation would be charged for 6 months, right? Because in the third year you have used it only for 6 months. So it will be half of 16,000. So 8,000. So first you will charge the depreciation account debit 8,000. It is sold for 1,20,000. So once you deduct depreciation from 1,28,000, your book value is 1,20,000, and it is sold for 1,20,000. So entry for sale will be bank account debit to machinery account. So to machinery account 1,20,000. So that means it is no profit, no loss. So profit or loss will be 0. So these are all the entries as far as the sale of machine is concerned. Then again on the same date, we have purchased one more machine for 1 lakh. So you will have in the book value row only you can write 1 lakh. So now entry will be machinery account debit to bank account 1 lakh, and that is 1st October 97. Nothing else is happening. So you will close the year by charging depreciation for the remaining 2 assets. So for the second machine, this year it will be full year's depreciation. So which will be 10% of 1,04,000. So 10,400. And third machine is purchased on 1st October. So it will be only 6 months depreciation. So 10% of 1 lakh divided by 2, 5,000. So both the machines put together, the depreciation amount will be 15,400. So depreciation account debit to machinery account 15,400. Then the balance amount will be carried forward. Then next year, 1st October 98, the second machine was sold for 92,000. So second machine is sold for 92,000. So first let us charge depreciation. Your book value, starting book value is 88,400, and this is 95,000. This year, again it is sold on 1st October, so that means the machine is used only for 6 months. So you will charge only half year's depreciation. So that will be 5,200. Depreciation to machinery account 5,200, 1st October 98. So your book value in that case will be 88,400 minus 5,200. So that is 83,200. And it is sold for 92,000. Entry for 92,000 will be bank account debit to machinery account. So machinery account credit side by bank account 92,000. So book value 83,200. We have sold it for 92,000. That means there is a profit of 8,800. So profit is always credited, and hence machinery will be debit. So machinery debit to profit on sale 8,800. So all the entries for the second machine are over. Then at the end of the year, it was decided to change the method of depreciation to WDV, and the new rate being 15% per annum. So on the last date, when it is decided to change the method of depreciation, the only asset that is remaining is basically the third machine. So now what you need to remember is, whenever there is a change, so obviously for first 2 machines there is no question of any readjustment, because these machines are anyway no more in the business. So you will do whatever adjustment is required only for the third machine. What you need to remember is, basically whenever there is a change in the method of depreciation, the change happens with retrospective effect. So 15% depreciation will be calculated on WDV basis right from the beginning. And in that case, what you will do is, this year, first year, your depreciation would have been 1 lakh into 15% divided by 2, because this year it was used only for half the year. So your WDV, or rather the book value, would have been 92,500. Then in the second year again, you will charge, now this is the new method is WDV, so you will charge 15% on 92,500. So that is 13,875. So this actually would be your total depreciation. This will be your depreciation for the current year as per the new method. So now what you will do is, this 13,875 will be obviously the current year's depreciation. So you will say by depreciation account 13,875, and then whatever adjustment is required for the prior period, that is, see, prior period actually the depreciation as per new method is 7,500, whereas you have actually charged 5,000 as per the old method. So now you need to charge 2,500 more. So that means this 2,500 more you will charge as a credit to machinery account, and debit will be P&L. So 2,500. So basically this year for this machine you are totally writing off 16,375. Right? So in that case now your book value for the third machine will be 78,625, which is 95,000 minus 16,375. So we have given the effect retrospective. So now nothing else is happening. So you will close the account by carrying forward the balance to the next year. So that becomes the opening balance. The care needs to be taken that this balance ultimately should tally with your working note also. So if you look at the working note, first two machines are anyway sold. So now the balance should be of the third machine only, which is as per our working note, it is 78,625, which is matching with our ledger, 78,620. So this is how you will prepare the ledger account in case of sale, change in the method of depreciation.